Good evening, students.
Good evening, sir.
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 Shall we go for round 2 now? Let me share the screen where we stopped last time. Cost of capital. We'll start today. We've done leverages yesterday. Okay, in leverages, I just wanted to mention one point. Given the leverages filling up the revenue statement, those types of questions are frequently asked in the examination. Just go through the certificate question also of 2019. You also have, I think in my CAPS material, I'm also having problems where the ratios are given, the leverage ratios are given, and you are supposed to fill up the revenue statement from the given leverage ratios. So that is one thing I forgot to tell you yesterday. Let us now start with cost of capital. Concept of cost of capital, we have done this concept. There are three concepts of cost of capital that we have studied. One is that it is the cost of issuing, cost of raising and using the capital. That is cost of raising the capital, your share issue expenses, underwriting commission, brokerage, registration charges, stamp duty, and the cost of using the capital, interest and dividend. Interest always net of tax, and dividend before calculation of tax. Okay, so that is the first concept of cost of capital. Second concept, it is a minimum rate of return required by an investor from his investment in a particular industry. And third is it is a minimum rate of return expected by a company from its investment in some project that it has invested. So these were the three concepts of cost of capital. Relationship. Normally, you can expect a question on this as a daily question. And as I told you earlier, when we were doing this from the point of view of, I think even my lectures, I told you that normally they ask you daily questions on this particular part in pairs. So if they ask you, they will ask you historical and future pairs. They will not only ask you historical, they will ask you historical and future pairs. So it normally comes in pairs. Then explicit and implicit cost, then average and marginal cost. Okay, so those things have been already covered by me during the lectures. So you can refer to the CAPS material, page 67. Then the formulas we come to cost of debt, KD. Cost of debt, we can have either irredeemable debt, which is lifelong debt, where only the interest is payable, so the cost payable is only the interest. So interest net of tax upon subscription value. The subscription value is the issue price minus the flotation cost. Always remember, issue price minus the flotation cost. Then the redeemable debt is there, where you will be paying a part of the principal and a part of the interest also. Or you may be paying the entire amount of principal at the maturity date, but interest is payable on a regular basis. When you make the payment on the maturity date, you may be paying more than what you have received. If your issue price was something like 110, you may redeem at 125. So the difference between the redemption value and the subscription value becomes an additional cost for the company. Because the company is paying more than what it has received. So it becomes an additional cost for the company, which will be divided over the number of years of which the debentures are issued. So it will be interest net of tax plus RV minus SV upon N. N is the number of years, and divided by average investment, which is RV plus SV upon N. Then we have cost of reference capital, that is again divided into two parts. We have irredeemable preference capital, irredeemable, where the preference capital is not to be redeemed during the lifetime of the company. So that is preference dividend divided by subscription value. But if in the question they have given dividend distribution tax, only if they have given the dividend distribution tax, then your preference dividend gets multiplied by 1 plus DDT. So DDT is your dividend distribution tax which will be added. It is 1 plus. Normally students get confused. Interest is 1 minus the tax. Because interest is net of tax. You get the tax benefit. On preference dividend, you don't get the tax benefit. On the other hand, company has to pay additional dividend distribution tax. Okay, remember that. If your preference capital is redeemable during the lifetime, that means redeemable within 15 years or 20 years or 10 years, then in that case, the formula changes. It becomes preference dividend into 1 plus DDT. Now, this 1 plus DDT I've written here, but it is always to be taken only when you have the dividend distribution tax given. Okay? If the dividend distribution tax is not given, this will not come. This part will not be. So only if they specifically mention dividend distribution tax, do not go to write your own dividend distribution tax because you have studied in tax, don't show your tax knowledge here in FM, not appreciated, do not get additional marks. In fact, your existing marks will be reduced. So don't go to show your tax knowledge over here. Dividend distribution tax to be considered only if it is specifically mentioned in the form. Just forget. So then PD into 1 plus DDT upon plus RV minus SV upon 10. This is a differential value upon average investment RV plus SV upon 10. Cost of equity, we are having different formulas here. Cost of equity dividend growth approach. Now both these approaches are called as Gordon's approach. Now if this is Gordon's growth approach, then it is the first one. If they say Gordon's price approach, it is the second one. Gordon's dividend growth approach, first one. Gordon's price approach, it is second one. But both are given by Gordon only. So the first one, if nothing is given in the problem, you have to go for the first one, first formula. So always remember, I have taught you also in the same order in which you have to apply. So first preference is always given to dividend growth approach. B1 upon B0 plus G. B1, dividend, expected dividend at the end of the year. Read the problem very carefully for these types of questions. Why? Because this is current dividend paid is 2 rupees. Current dividend is P0. Sorry, D0. Current dividend is D0. So you will have to calculate D1 because in the formula I require D1. So current dividend or dividend paid for last year all implies D0. Okay. Only when they say expected dividend at the end of current year, that is D1. Okay. So D1 upon P0, current price, current market price is P0 plus growth rate. If growth rate is not given, I told you what to do. If growth rate is not given, see whether you can calculate growth rate. How? In the problem, they must have given you that the net income is a particular figure, that is earning per share is given to you as 10 rupees and dividend per share is given to you as, let us say, 7 rupees. So what does it imply? It implies that 3 rupees is retained earnings. And if retained earnings are there, then growth rate is there. So growth rate, if it is not given, see whether you can calculate growth rate. Okay. Check whether you can calculate growth rate. If growth rate is not given, it may be possible that they have given you this information. EPS and DPS. So earnings are 10 rupees. You have got 10 rupees available for shareholders. How much dividend you have paid? Only 7 rupees. So the balance 3 rupees is retained in the business. So you'll have to calculate growth rate. How to calculate growth rate? I told you. G is equal to B into R. Okay. What is B? B is the balance amount. Balance amount is 3. But you have to calculate 3 upon 10. Out of 10 rupees, it is 3 rupees. So ratio of balance ratio is 3 upon 10. Returns on equity. R is your returns on equity. R is returns on equity. So this will be given to you in the question. To multiply the two, you will get your growth rate. So always keep your mind alert. That is why we always tell the students that you should have a good proper sleep before going for the exam. Because your mind must be working super fast and it must be super alert within those 3 hours. After the 3 hours you go to sleep, that is not issue. But before, during that 3 hours which are crucial, your mind must be alert and working fast. Right? So, what you have to do is growth rate. Remember this point. Always remember this point. I've told you at the time of solving the questions also, and now also in the revision lecture. Growth rate is not given, it should ring a bell. Sir has said something. What sir has said? Ring a bell and not stop over there. You have to recollect also. Like yesterday the bell rang. That something has to be done. Concept has to be taught. But what concept is to be taught, you forgot. Right? So bell should ring and it should remind you what I have said. I have said that if growth rate is not given, check whether you can calculate growth rate by the formula B into R. You check for what dividend per share is given, earning per share is given. Because normally what will happen is when earning per share is given, you are tempted to use this formula. You are tempted to use this formula. Don't use until and unless you confirm whether growth rate can be calculated. Okay. So along with EPS, we are given the TPS also. That means growth rate has to be calculated. Fine. So when the growth rate is not given, additional responsibility for you to check whether growth rate can be calculated. Check out for these two figures given in the question, EPS and EPS. Find out the retained earnings, find out the proportion of retained earnings to EPS, and find out the B value, that is B ratio. Then returns on equity must be given to you in the question. Locate that, multiply the two, calculate it. Okay, so that is for the first formula. The second formula is dividend upon price. If growth rate is not there, if retained earnings are not there, or they have given in the question that entire profits are declared as dividend. If entire profits are declared as dividend, then there is no retained earning. Then there is no need to break your head to find out the growth rate. It is growth rate is given. But I also told you that we have also done one problem where growth rate we had been given that entire profits are declared as dividend, but they had said company is coming out with fresh issue. So what is the logic of growth rate? I told you the logic of growth rate is that if the retained earnings are reinvested in the business, there will be growth rate. Second, if additional equity capital is invested in the business, then there is growth rate. So even if the entire profits are distributed as dividend, if they have said that company is making a fresh issue of shares in the current year, then growth rate is there. Okay, so these are all the points that you have to rule out. Then you can calculate dividend upon price. Where again, price is what your subscription value, your net issue, that is your proceeds from the issue minus of quotation cost. Earnings price approach, it is EPS upon MPS. Now here also I told you one more thing. What is that? This can be written as 1 upon P ratio. 1 upon P ratio. CAPM approach is plus sign is missing over here. Please write the plus sign. This RF plus, please write the plus sign. RF plus beta into RM minus R. Okay. So KE is equal to RF plus the plus sign was missing over there, plus beta into RM minus R. Beta will be given to you, RF will be given to you. Okay. RM will be given to you, just have to substitute. No, RM may not be given to you when, if they say that market risk premium is given, then I need not give you the RM separately because market risk premium is itself is RM minus R. Market risk premium itself is RM minus R. So if I give you market risk premium, it is equal to RM minus R. So again, then don't go to calculate RM. Not necessary. Then you have cost of retained earnings. Normally, if nothing is given in the question, I have said that cost of retained earnings is equal to cost of equity. Where they have given personal rate of tax or they have given brokerage, then your formula for cost of retained earnings is cost of equity into 1 minus TP. TP is your not time pass, it is TP is personal tax. So 1 minus personal rate of tax into 1 minus brokerage. That will give you the cost of retained earnings. Okay. Weighted average cost of capital, WACC. Once the specific cost of capital is calculated, combined cost of capital called the WACC is calculated. It is also called the composite cost of capital or the overall cost of capital. So either we can denote it as WACC or you can denote it as KO. Okay. Weighted marginal cost of capital is the new or incremental cost of new capital issued by the company if the new capital is raised in the same proportion as the existing capital and the cost of capital remains the same, then the WSCC is equal to WMCC. That is what we are doing. So now, this is a typical examination question. Why? Because there is a reason for that. We have to calculate the cost of debt over here. Okay, with a bit additional calculations over there. Let us go through the example. Navya Limited wishes to raise additional capital of 10 lakhs for meeting its modernization plan. It has 3 lakhs in the form of retained earnings available for investment purpose. Following are the further details given. Debt equity mix is given 40 to 60%. Debt is 40, equity is 60. Cost of debt before tax is given up to 1,80,000, 10%, beyond 1,80,000, 16%. So here it is like your income tax slabs which are good. Up to 1,80,000, it will be 10%. And if it is 2,60,000, for the first 1,80,000, it will be 10%. And for the remaining balance, it will be 60%. So earnings per share is given 4, dividend payout ratio is given 2. Expected growth rate in dividend is 10%, current market price per share is 44, and the rate of tax is given as 50%. You are required to determine the pattern for raising additional finance. Second, calculate the post-tax average cost of additional debt. Third, calculate the cost of retained earnings and cost of equity. Also, we have to calculate the specific cost of capital. And the fourth is to determine the overall weighted average cost of capital after tax. So total capital required is 10 lakhs. 40% of that is 4 lakhs. That is in the form of debt. 60% is in the form of 6 lakhs. So what you can do is you can prepare a table like this. You can show the classification. It's 10 lakhs. Break up the 10 lakhs. 40% debt. Okay. Debt is 40%. 4 lakhs here. And equity is 60%. So that comes to 6 lakhs. And then show the breakup of 6 lakhs. 6 lakhs can be further broken up into company already has retained earnings. Retained earnings are already given to in the company in the form of 3 lakhs. Okay. So out of that 6 lakhs, 3 lakhs is retained earnings. So the balance 3 lakhs which is required, that is going to be coming in the form of equity shares. Balance 3 lakhs. Okay. So instead of writing the statements like this, you can just show the classification. So for you also, it becomes clear to what is how much is debt, how much is equity. Out of that, how much is already existing with us, how much we have to raise. Okay. Or you can write in statement. No issue. Then out of debt, what we have said, first 1,80,000, the rate of interest is going to be 10%. So again, debt we come to the first 10, the 4 lakhs. Out of that, you can show the 4 lakhs. Out of that, the first 1,80,000, that is going to have 10% interest. Over and above 1,80,000, balancing figure 2,20,000, that is going to carry 16% interest. So we will calculate 10% of 1,80,000 is 18,000. Okay, and 16% of 2,20,000. So 2,20,000 into 16% will give you 35,200. Right? So then you will take the total of this. But they have asked you typical questions. So you have to give answers to the point. First, they have said determine the pattern for raising additional finance. So you have to give them the capital structure. So what you will give them as capital structure? Equity share capital 3 lakhs. So this 3 lakhs will show you. Retained earnings 3 lakhs. So this 3 lakhs will come down. 10% debt 1,80,000. This 1,80,000 will come down. And 16% debt, that is 2,20,000. So first show the capital structure because that is the first part of the question. Second part of the question, calculating the cost of debt. So calculating cost of debt, I'll say that 1,80,000, 10% comes to 18,000, 2,20,000, 16% comes to 35,200. Take the total of this. 53,200 is the total amount of interest that we are paying. 53,200 net of tax. So 1 minus rate of tax. Upon the total debt capital, 4 lakhs into 100. So your specific cost of capital, cost of debt comes to 6.65%. always refer to minus the rate of tax, 1 minus 2. Because your cost of debt is never the interest, it is your interest net of tax. So 53,200 is your total amount of interest paid on 4 lakhs multiplied by 1 minus rate of tax will give you the cost of debt, 6.65%. Then we have cost of equity. Cost of equity, dividend is given as 2. Okay. Look here. Dividend payout ratio. Dividend is 2. So dividend is 2 rupees. And that is paid out of your earnings per share, 4 rupees. Okay. Now they have given. Purposely, I have told you this in the solving of problems also, that they have given dividend payout as 2 rupees. They have not given whether it is expected dividend or the present dividend. I would say that this dividend payout, this is D0. Okay. So institute also, they have given 2 different answers for 2 different examinations. In one, they have taken this as D0 and so on. In the other suggested, they have taken it as D1 and so on. We will take it as D0 because we have given the expected growth rate in dividend. Earnings per share they have given as of now. They have not given expected earning per share. They have given earning per share as of now 4 rupees. So dividend also is paid out of that only. That is current dividend D0 2 rupees. So that is going to increase by 10%. So 2 plus 10%. How to write 2 plus 10%? Either you can write 2 plus 10% or you can write 2 into 1.1 upon 44 rupees. Okay. That is your current market price plus 10% growth rate. So that will come to 2 into 1.1 is 2.2 upon 44 is 5%. 5% plus 10% is equal to 14%. Once you get this, your WSCC calculation table. Source, amount, cost, and weighted cost. Equity capital 3 lakhs, retained earnings 3 lakhs, debt amount 4 lakhs. Cost you have already calculated. Nothing is given. So I assume that cost of retained earnings is equal to cost of equity. If they have given me the personal rate of tax, which they have done in some problems, or the brokerage, then I will take cost of equity into 1 minus the personal rate of tax into 1 minus the brokerage. Since in this problem they have not mentioned anything, I just assume that cost of equity and cost of retained earnings are the same. So 15% will come in both the cases. And then your debt that you have calculated 6.65%. 3 lakhs into 15%, 45. Again 45. 4 lakhs into 6.65. That comes to 26,600. Total of that is 1,16,600 divided by your total amount. That gives you the WSCC 11.66%. Okay. So it's a typical examination question, favorite of the examiner, because here sometimes students make mistakes, and therefore, they want students to make mistakes. Our objective is to ensure that examiner does not cut my marks. Always ensure. From day one, I have told you that our objective should be that examiner, our presentation should be such that examiner does not find a reason to cut my marks to deduct my marks. Okay. So everything is clear. So cost of capital, WSCC calculations. Capital structure plan. First thing, optimal capital structure. Optimal capital structure. They have asked as a part question in a practical question. They have asked 8 marks question, 6 marks problem, and 2 marks for this. They have asked what is optimal capital structure. 2 marks question. I told you this yesterday also. Financial break-even point. They had asked for 2 marks along with the practical question. The numerical question was asked, and at the end they asked you define financial break-even point. So for 2 marks, small concepts like this can be asked. And we have it. So optimal capital structure. Optimal capital structure is that capital structure where the weighted average cost of capital is the minimum. Okay. And it maximizes the shareholders. So that level is called as optimal capital structure. Then in the theory question, they have asked you factors affecting capital structure. A detailed discussion on that we have done when we were doing the topic. Factors that you have to write: total risk, returns, control. At least 5 to 6 points should be there. not saying write all the points, remember all the points, but if you remember all the points, well and good. But at least 5 to 6 points should be there with the explanation. Because your question will be for 4 to 5 points. At least 5 to 6 points should be mentioned in the points. So total risk, returns, control, cost, flexibility, solvency, taxation effect. Whichever you can remember fast, you can write. Taxation effect because debt is net of tax. You can remember that fast. Risk because more of debt will have more of risk. Returns, whichever is which you want maximum returns on, the risk will be high. Control, dilution of shares. If you don't want dilution of shares, then don't go for equity shares. Then cost, whichever has got the minimum cost, debt has got the minimum cost, so you go for both debt. Flexibility, where you can redeem the capital as and when you don't require it. Redeemable preferential capital and debt capital, redeemable debt. Okay. Solvency. Okay. Solvency means where you have the necessary cash for making payment of interest and dividend. You can go for preferential capital. You can go for debt capital. But if you feel that cash may not be there, in that case, go for equity capital. So like that, small points, 2 points. That is once you write the point, 2 lines. Don't go and write paragraphs and pages and pages. No, this is not required. When they have 4 to 5 marks, you have to write to the point. Write 5 to 6 points, and each point 2 to 3 lines, maximum 2 to 3 lines. Normally the students will have this habit of asking because college examination you are habituated. Sir, for 5 marks, how many pages to write? I can't tell you how many pages to write. I can't tell you how many lines to write because handwritings differ from student to student. I tell you 1 page to write, but your handwriting is big, then you will get tension. If I tell you half a page to write, okay, you'll still get more tension because my handwriting is big. If I tell you you have to write 2 pages for 5 marks, but your handwriting is like mine, small, Chintu handwriting, then you will get tension again. So I don't tell you how many pages to write or how many lines to write. You have to write to the point. 5 to 6 points must be there. Highlight the points, number the points. So examiner knows that you have covered 5 to 6 points. Number the points. Okay, underline in pencil. And write maximum 2 to 3 lines on each point, describing that point. What is it? Preferably give an example. That will be solving the problem. Okay. So that is factors affecting capital structure. Then I told you common assumptions of capital structure theory. 6 common assumptions we are discussing. 3 relating to the balance sheet and 3 relating to the income statement. Very important. So, common assumptions of net income theory, net operating income theory, and MM theory. All 3. There are 6 common assumptions. 3 pertaining to the balance sheet, 3 pertaining to the revenue statement. Balance sheet items. First, we said that there are only 2 sources of capital: debt and equity. Second, the total of debt and equity always remains constant. Capital employed remains constant. Third, because of the first two, that there are only 2 sources of finance and the total remains the same. If one increases, the other has to decrease. So the equity increases, debt has to decrease, and vice versa. So these 3 points are from the balance sheet, related to balance sheet items. Remaining 3 points relating to revenue stream. EBIT must remain constant. So that is the assumption. Then we assume that there are no corporate taxes, no transaction costs, no brokerage, no commission, no share issue expenses, no corporate taxes. Okay. That means we are assuming that we are staying in the Gulf where no taxes are. So, 6th assumption, there are no retained earnings, entire profits are paid as dividends, so DPR is equal to 100%. Retained earnings are 0. Okay, so these are the 6 common assumptions of all the 3 theories. Then, I'll come to this. Additional assumptions for MM theory. Very important. So, these 6 assumptions. And after that, I will come down to the MM theory, 3 assumptions. Why? Because sometimes they ask you only the MM theory assumptions. So those 6 assumptions plus these 3 assumptions. additional specific assumptions for MN theory. Capital market is perfect. All investors are rational, meaning that they have got full knowledge of the market. And last one, that is the ninth one, is investor can substitute corporate debt for personal debt. Now, let me tell you, students, that if you write 8 points out of the 9 points, and this last one is missing, you are going to lose a lot of marks. You say, sir, I have missed only 1 point. Why they have got so many marks? Because that is a main part of your MM theory. Sometimes you are really don't know, you are not knowing as to why the examiner has cut so many marks. 5 marks question, sir, yes, give me only 2.5 to 3 marks. I deserve because I have written all 8 points of it, 9 points I have not written. So he has cut so many marks. Unjustified. You feel it is unjustified, but that is the most important point. That is the most important point. So, last time when I was in Bangalore, I was teaching a student from CA final. One day he came, he was very tensed. He came from office, from the lecture. He was very tensed. I asked him what happened. He said, my boss gave me a big firing bill. Right? Sir, I did a small mistake. Sir. What small mistake you done for that you got such a big fire? He said, sir, I was filing GST returns. So instead of writing the quarterly figure, I wrote annual figure. Such a small mistake I made, and he fired me. So I asked him, what is the quarterly figure? He said it was something 55 lakhs. So what is the annual figure? He said 2.5 crores. And over and above that, he said, I did a small mistake. Instead of writing quarterly figure, I wrote annual figure. So sometimes you feel that your mistakes are very small. And you should not be given such big punishments. But that is the most important part of your assumptions. Out of the 9 assumptions, this the last assumption is the most important. So if you don't write that, don't expect to get more than half the marks of your answer. Because that is the crux of the theory. That is the main part of the theory. Okay. So remember these small things which will get you a lot of benefit in the exam. So common assumptions, it's a common assumptions plus 3 assumptions of MM theory, total 9 assumptions for MM theory. What are the steps for solving the problem? Capital structure theories. First one is net income theory. The net income theory. First, I start with the EBIT. The EBIT is not going to calculate the EBIT. And then I will calculate net income available for equity shareholders. EBIT is also called as operating income, so net operating income. From there, I minus the interest, I will get the net income. Because we have said that there is no profit, no tax, so there is nothing like profit before tax and profit after tax. We have said that only debt and equity, so no difference unit is possible. So obviously, from EBIT, when I minus the interest, I will directly get the net income. So what will happen here? The format will be EBIT, whatever the amount is, minus the interest. Okay, and you will get your net income available for shareholders. So there is nothing like profit before tax, profit after tax, because we have assumed that no tax. Okay, then after doing that, you will calculate the market value of equity. S is equal to net income divided by cost of equity. After that, you will calculate market value of debt as D is equal to interest divided by cost of equity. When you get the market value of equity and market value of debt, you add those two and you will get the value of the business. And from there, you will calculate the overall cost of capital that is given. Okay. For net operating income theory, you start in the same way. Okay. EBIT is good. But now what do we say here? The additional points of net income theory is that KD and KE are given. Let me say a constant. Okay. They are given in the question, so they are constant. So since KD and KE are given, KO is to be calculated. This is to be calculated. Okay. Net operating income theory, what is given? KD is given and KO is given. So what we have to calculate? We have to calculate cost of equity. Cost of equity is not given. We have to calculate. So you'll start with EBIT, you'll arrive at net income, but then you will calculate total value of business by the formula EBIT upon KO. Because KO is given. Deduct the market value of debt to compute the market value of equity. So your debt is equal to, sorry, your equity is equal to, S is equal to minus total value of the business which you get from here, minus the debt which is given to you in the business. Then compute the cost of equity as net income divided by market value of equity. Okay? And I'll give you all the notations here. D is equal to D plus S, D is equal to interest upon KD, S is equal to net income upon KE, KO, overall cost of capital, WCC, is equal to EBIT upon P. Okay? theory, additional assumptions you have to take care of. And most important thing over here is the arbitrage process. So whenever the word arbitrage comes in the theory, it is a theory. What is the arbitrage process? I told you. Normally, two companies having similar businesses, having the same type of production lines, should be having the same value. Since they don't have the same values, then the shareholders, the investors, the market investors, they try to bring equilibrium in the values of the two companies. How? They start, the shareholders of the overvalued company, they start selling off their shares and purchasing the shares of the undervalued. So, overvalued companies, shareholders, when they start selling the shares, the supply of shares increases, prices fall, value falls. They start purchasing the shares of undervalued company. Demand for the undervalued company shares increase, prices increase, and there will be a position where both of them are at an equilibrium value. That is what end of arbitrage process. Okay, so arbitrage process again important for short term. Then indifference point. Many times indifference point has been asked in the question. What is an indifference point? It is that level of EBIT at which the EPS for two alternative financial plans is the same. EPS is equal. And then above the indifference point, you would prefer to have more of debt. Below the indifference point, you would prefer to have less of debt and more of equity. In one paper, they had asked, when is financial leverage of a company? What is financial leverage? And when is financial leverage of a company enjoyed by the shareholders? So what was the question? They were asking the question based on what? They asked you, what is financial leverage? So first they asked you, what is financial leverage? Okay. Then they ask you, when is financial leverage beneficial? When is financial leverage beneficial? So it is a combination of two chapters. This what is financial leverage comes from the topic of leverage. When is financial leverage beneficial? It comes from this indifference. What means? Financial leverage is beneficial when your actual EBIT is more than the indifference, is higher than the indifference. Then you get the benefit of financial leverage. See, I have written here also. If the expected level of EBIT, that means what you are going to get, your actual level of EBIT, exceeds the indifference level, then the use of fixed charge source of funds would be advantageous. And this financial leverage will lead to increase in EPS. The concepts you have studied in two different chapters, but you should know how to relate them. So in the question they ask you, what is financial leverage? That you can explain. But when is financial leverage beneficial? The financial leverage is indirectly they are asking the indifference point concept. So financial leverage is beneficial when your expected EBIT or your actual EBIT is higher than the indifference point. Okay. Then again, I come back to financial break-even point. Financial break-even point is that point at which the profits earned by the company are just sufficient to meet the fixed charges like interest and preference rate. So, if you want to express it in the form of equation, I can write that EBIT is equal to interest. provided preference capital is not there. But if preference capital is there, then EBIT is equal to interest plus preference dividend. But whenever I write preference dividend, I have to divide by 1 minus 2. Why divide by 1 minus 2? Because preference dividend in the format of the revenue statement comes post-tax. Preference dividend in the format comes post-tax, after calculation of tax. But since you are showing this now, EBIT should be equal to what? EBIT is pre-tax. Interest is pre-tax. So preference dividend also should be pre-tax. So how to convert the preference dividend pre-tax? Divided by 1 minus 2. Whenever you have to convert something into pre-tax figure, you divide by 1 minus 2. If you have to convert into post-tax figure, you multiply by 1 minus 2. Isn't it? Cost of debt, you want. What you do? You say interest net of tax. You multiply by 1 minus 2. But here I require preference dividend, pre-tax, divided by 1 minus 2. Okay. So in that case, you can give these two figures. That is this or this. That means your preference capital is there. It is interest plus EBIT should be sufficient to meet the interest plus the preference dividend before tax. Okay. Let's come to the first example. Management of Z Limited wants to raise funds from the market to meet out the financial demands of the long-term projects. Company has various combinations of proposals to raise its funds. You are given the following proposals of the company. So 3 proposals are there. They are called as P, Q, and R. And a percentage of equity, percentage of debts, and percentage of preference shares. Okay. So in plan P, 100% is financed in the form of equity. Plan Q, 50% in equity and 50% in debts. Plan R, you are having 50% in equity and 50% in preference shares. Cost of debt is given as 10%. Cost of preference is 10%. Tax rate is 50%. Equity shares with a face value of 10 rupees each will be issued at a premium of 10 rupees. So issue price of the equity shares is 20 rupees. Issue price is 20 rupees. Total investment to be raised is 40 lakhs. Expected earnings before interest and tax EBIT is 18 lakhs. From the above proposals, the management wants to take advice from you for appropriate plan. That means you have to find out which is the most appropriate plan. After computing the following: first, EPS, second, financial breakeven. Now, whenever you have to make a selection out of the different plans available, selection is always to be done on the basis of EPS. Whichever financial plan gives you the highest EPS, that financial plan will be selected. Okay. So they have asked you to calculate EPS of the 3 financial plans and also the financial break-even part. Financial break-even of the 3 financial plans. Then they have asked you to compute the EBIT range. The purpose of giving you this problem in the division part is that they want the range. I want to explain to you this part. EBIT range among the plans for 2 difference. Nothing different that you have to calculate the EBIT, you have to calculate the indifference point. But how to write the answer, how to present the answer is the question is given this way. This is also called as in your study material as EBIT EPS analysis. So one student had pointed out to me that, sir, we have not done one part of our syllabus. That is EBIT EPS analysis. It is nothing but calculation of indifference point and calculating the EBIT rate. So I have not used the word EBIT EPS analysis, but it is the same. Okay. Now, how to solve? First, what we do is for the 3 plans, I write down the capital structure. In plan P, the entire 40 lakhs is financed by equity. So entire 40 lakhs in the form of equity. In plan Q, you are having preference and equity. So equity and debt. Plan Q, equity and debt. And in R, you are having equity and preference. Okay. R, you are having equity and preference. So accordingly, 40 lakhs 2020 it will be separate. Now revenue structure everywhere 18 lakhs EBIT will be the same. Interest will be there for only plan Q because debt is there only in plan Q. Okay. What is the rate of interest? What is the cost of debt given to us? 10%. Okay. 10% is the cost of debt, 10% is the cost of preference. So 10% of 20 lakhs will be 2 lakhs. Okay. So that 2 lakhs is there only for plan Q. So 18, 16 and 18 lakhs. That is your net profit before tax. Minus the tax at 50%, 9 lakhs, 8 lakhs and 9 lakhs. You get net profit after tax. Preference dividend 10% again of 20 lakhs. So 2 lakhs over here. So net income available for equity shareholders. This is your net income available for equity shareholders. 9 lakhs, 8 lakhs and 7 lakhs. Number of equity shares. Nothing is given. Then I will take it as 100. But let me see if they have given the equity share. Yes, issue price is given. 20 lakhs. When the first case 40 lakhs gets divided by 20. 40 lakhs gets divided by 20. I have 2 lakh equity shares. Second case 20 lakhs gets divided by 20. I get 1 lakh equity shares. Third case 20 lakhs gets divided by 20. I get 1 lakh equity shares. So EPS 9 lakhs divided by 2 lakhs 4.5. 8 lakhs divided by 1 lakh 8. 7 lakhs divided by 1 lakh 7. Which is giving me the highest EPS. Highest EPS is 8 lakhs. So which plan to be selected? This plan. Okay. But they have asked me to also calculate the financial breakdown. See, how to know whether your answer is correct or not? Logically speaking. So if you are solving the problem and you are having this type of a capital structure, wherein one you are having only equity, second you are having equity and debt, and third you are having equity and preference. Always remember, debt has got more benefit because of tax savings. Debt has got more benefit because of tax savings. So because of that, there will be financial leverage. Because of financial leverage, the earning per share for the equity shareholder should be the maximum. So all practical possibilities, earning per share for the debt plan should be maximum. Remember this one. So any problem you take, any figures you take, okay, the plan which is having debt component will have highest earning per share. So that is your answer. Okay, to this. So we can see that we are having the debt component. Okay, debt component is there. That is why you get the benefit of financial leverage, and as a result of that, your earning per share is more. Okay, now what is financial break-even point? I have to write there because they asked me to calculate the financial break-even point. So financial break-even point is that point where the profits are just sufficient to meet the fixed charges, like interest on debt and preference. Okay, so in plan P, there is no debt, there is no preference capital. There is no debt, there is no preference capital, no fixed charge. So financial break-even point is 0. Okay. In plan Q, we have debt capital, only debt capital. Preference capital is not there. So what is the interest over here? Interest over here is 2 lakhs. So EBIT when it is equal to 2 lakhs, that is the break-even point. Where EBIT is equal to 2 lakhs. Okay. Plan R, financial break-even point. I told you where EBIT is exactly equal to the interest, but in plan R we don't have interest. What do we have in plan R? In plan R we have preference dividend 2 lakhs. But I told you what? That if preference dividend is to be taken, you have to divide by 1 minus t. Right? So I have taken preference dividend 2 lakhs. Okay, and I have divided by 1 minus t. So 2 lakhs divided by 1 minus 0.5 gives me the amount of break-even point. Okay, so remember all these small issues. Now, this is for range calculation. Now, for range calculation, I will have to calculate the indifference point between all the 3 plans. Since 3 plans are there, there normally should be 3 indifference points. Between P and Q, one indifference point. Between Q and R, one indifference point. And between P and R, one indifference point. Okay, so like that, we should be having three indifference points. Now, the first one I take indifference. Now that is the maximum. I'm not saying that exactly 3 points should be there. I'm saying maximum 3 points should be there. Between any two financial plans, there will be one indifference. So now I start with P and Q. Now P and Q, P is not having any interest, not having any preference with Q is having interest. So when I write the formula, I have to take care. So in P, when I write, I say EBIT net of tax. Why EBIT net of tax? Because interest is not there. So it is EBIT 18 lakhs minus tax 9 lakhs. Straight away I can do. Okay. So EBIT net of tax divided by number of equity shares in plan P should be equal to. Now here I have got interest. So it is EBIT minus interest. EBIT minus interest. Net of tax divided by number of equity shares in plan Q. EBIT into 1 minus T, 1 minus 0.5 is 0.5. EBIT minus interest, 18 lakhs minus interest, or whatever it is. EBIT minus 2 lakhs into 1 minus T is 0.5. So this 0.5 and 0.5 will cancel. Okay. This will cancel. So it is EBIT upon 2 is equal to EBIT minus 2 lakhs upon 1. Cross multiply this. So EBIT is equal to 2 times EBIT minus 2 lakhs. EBIT is equal to, open out the brackets, 2 times EBIT minus 4 lakhs. 2 times EBIT minus EBIT is EBIT equals to 4 lakhs. So for the first two plans, P and Q, you have the indifference point. This is the indifference point between P and Q. Okay. Now we go for plan P and R. Now plan P and R, what is the nature of plan P and R? P is having debt, R is having preference rule. Okay. So for the plan P, sorry, P is not having any debt, no debt, no preference capital. So for plan P, it is straight away from here I bring this down. EBIT net of tax upon number of equity shares in plan P. Plan R has got preference rule. So EBIT net of tax, no interest is there, minus the preference rule, divided by number of equity shares in R. First part remains the same, EBIT into 1 minus 3, that is 0.5 upon 2 lakhs. Second part, right hand side, EBIT net of tax is 0.5 minus preference rule, which we have calculated here, preference rule 2 lakhs. So that preference rule comes in. Upon number of equity shares in plan R, number of equity shares in plan R is 1 lakh. Now again, now here you can't cancel 0.5 because 0.5 is not multiplied. It is having a minus 2 lakhs over here. So you can't cancel this. What you can cancel is only these zeros. Run cross multiply. EBIT into 0.5 is 0.5 times EBIT. 2 will cross multiply on the right hand side. 2 into 0.5 is 1 EBIT. 2 into 2 lakhs is 4 lakhs. So minus 4 lakhs. Right? EBIT minus 0.5 EBIT is 0.5 EBIT equals to 4 lakhs. So EBIT is equal to 8 lakhs. Okay. So this is your indifference point between P and R. Okay. Now we have indifference point between Q and R. Right. Now indifference point between plan Q and R. Q is having debt, so EBIT minus interest net of tax upon number of equity shares in Q. R is not having debt but having preference dividend, so EBIT net of tax minus preference dividend divided by number of equity shares in R. EBIT minus interest of 2 lakhs into 1 minus T 0.5. EBIT into 0.5 1 minus T. Preference dividend is 2 lakhs. And this EBIT minus 2 lakhs into 0.5. Now, normally, even the exams will not believe. Students have cancelled this 1 lakh, and they said 0. How can you have 0? until and unless you get the answer 0. So 1 lakh and 1 lakh does not give you 0 because 1 lakh, 1, 1 lakh, 1. Denominator is 0. Doesn't make a difference. Then what remains is only the numerator. EBIT minus 2 lakhs into 0.5 is equal to EBIT into 0.5 minus 2 lakhs. Now when you open out the bracket, 0.5 into EBIT is 0.5. EBIT 0.5 into 2 lakhs is 1 lakh. 0.5 EBIT minus 2 lakhs. Now you can say 0.5 EBIT and 0.5 EBIT cancels, and therefore there is no indifference point between plans Q and R. So between P and Q there is an indifference point. Between P and R there is an indifference point. But between Q and R there is no indifference point. So how to write the answer? We'll say from the above calculations you can observe that plan Q has the highest EPS and also the lowest financial break-even point. So plan Q dominates all other plans. What is the range of indifference point? EBIT. The range of EBIT 4 lakhs. That is the maximum. No, you've got 8 lakhs here. And this is 0. So 0 to 8 lakhs. So EBIT range of the three financial plans is 0 to 8 lakhs. Okay. Any questions? Anything you want to ask?
Sir, explain the range.
Range is from the lowest to the highest. Lowest of all the three indifference points is 0. The highest of the three indifference points is 8 lakhs. So that is your range of the three financial plans. If you are taking one plan at a time, so you can say 0 to 4 lakhs. Okay. And for financial plan A, you can say that the profit, the bond from where you start making profit is 4 lakhs. So 4 lakhs to 18 lakhs. Now your existing profit is 18 lakhs. So 4 lakhs to 18 lakhs is the bond in the area in which you are going to make profit. For plans between your P and R, if you are taking the plans P and R, between those two financial plans, the EBIT is 8 lakhs. So above 8 lakhs, you start making profit for plans P and R. So 8 lakhs to 18 lakhs will be your profit area. Because I said that more of net capital will be preferred when you are having your actual EBIT above the indifference. Okay. And the last one is between Q and R. Between Q and R, your Q and R, the EBIT is going to be 0. So 0 to 18 lakhs. Fine. So that is how you write the range. But you don't have to write it individually. You can just write the range of all the three financial plans. The minimum is 0. The maximum is 8 lakhs. So this is the indifference one. The EBIT ranges from 0 to 8 lakhs.
Yes, sir.
Yes. Example 2. Company P and Q are identical in all respects, including risk factors except for debt equity. Company P having issued 10% debentures of 18 lakhs, while company Q is unlevered, meaning that no debt is there. Both the companies earn 20% before interest and taxes on their total assets of 30 lakhs. Assuming a tax rate of 50% and a capitalization rate of 15% for all equity, 15% for all equity. Calculate the value of company P and Q using net income approach and net operating income approach. So, valuation under net income approach. What do we start with? We start with EBIT. They have given that companies earn 20% before interest and taxes on the total assets of 30 lakhs. That means that EBIT is 20% of 30 lakhs. Okay, so 20% of 30 lakhs will come to 6 lakhs. Then what they are asking is interest is good. Interest rate of interest is given as 10% debentures are 10% debentures of 18 lakhs. So 10% of 18 lakhs for company P, that is 1,80,000 interest will be there. Okay, so 6 lakhs minus 1,80,000 is 4,20,000. Company Q, it is going to be 6 lakhs. Rate of tax is 50%, so 2,10,000 and 3 lakhs will be. Profit available for equity shareholders, that is net income available for equity shareholders, 2,10,000 and 3 lakhs. Now, since we are following the net income approach, okay, cost of equity is 15% for both the companies. It is given to us. The cost of equity is 15%, so 2,10,000 divided by 15%. I'll get 14 lakhs. 3 lakhs divided by 15%. I get 20 lakhs. Add the amount of debt. Debt in the company P is 18 lakhs. So 14 plus 18, 32 lakhs. 20 lakhs is the value of company Q. This is under the net income. If I'm going for net operating income, then first I will calculate market value of the firm. How to calculate market value of the firm? Market value of the firm is 6 lakhs. That is EBIT minus the rate of tax. What is the rate of tax? 50%. Okay. Because interest is not there. So it is going to be 6 lakhs minus 50% divided by 15%. So that will give me 20 lakhs for both the companies. Value of debt 18 lakhs minus 50%. That is 9 lakhs. Total value of equity 11 lakhs. Add the value of debt, which is 18 lakhs. Total value of the company is 29 lakhs and 20 lakhs. So that is as per the net operating income. So I told you, net operating income approach. First we calculate the total value of the business. From that minus the value of debt, you get the value. Okay. So these are the types of questions which we can explain. Capital structure plan. And of course, MM theory questions which we have done. Remember that we have done 2 types of MM theory questions. Remember, MM theory, normal problem, normal arbitrage, and then reverse arbitrage problem. Remember the 2 types of MM theory questions. One is normal arbitrage. One is reverse arbitrage. What happens in reverse arbitrage? And what happens in normal arbitrage? Normal arbitrage, you are shifting from a levered company to an unlevered company. Right? You are shifting from a levered company to an unlevered company. Reverse arbitrage, you are shifting from an unlevered company to a levered company. Okay? So 2 types of questions we have done. So go through those 2 types of questions. When I say go through, it doesn't mean read, it means practice. Because only when you practice it, I'll tell you one thing. Solution for all problems, all professional problems, exams, is that students have lack of practice. You know, if you see the comments which are given by the examiners, you know, examiners are supposed to write comments at the end of the exam. See how the students are performed and where they feel that students are lacking. So if you read those, points which are written by the examiner, you find it shocking that most of the examiners are doing the same comments. That is, students are lacking writing practice, solving practice. That is why from day one I used to tell them, write and practice. Don't look at the problem and say, I know this problem, I know this solution. Because you may feel that you know, but when you actually sit down to write, you are unable to. The same thing happens with theory papers also. You are reading the material. Therefore, I remember when we were having face-to-face lectures, you know, Asha ma'am used to make the students write questions. I do not know whether you are doing the things now also online, but Asha ma'am used to make the students write the questions, write the answers. And so I used to find immediately after my lecture, they used to get over. Some students used to stay back in cabs. They used to open their books and start writing. So audit questions, law questions, is to write and practice. So only then you get the confidence that in the examination write in the same way and I can score. So that is very important. Any difficulty? Now we come to capital budget. Capital budgeting process. One examination, remote question. They ask capital budgeting process. What is the process of capital? Some students say it is out of syllabus. Even if it is out of syllabus, copy is there in the syllabus. You should know how planning is done, how the capital budgeting process starts. Capital budgeting means what? You are budgeting for purchasing of a fixed asset or investment in a particular project. So what are the steps? What is the process? Steps involved. First step involved is plan. What you are going to purchase, why you are going to purchase. If you are making investment in a project, what is the project? Okay. By investing in the project, how much benefit you are going to get? What are the things that you require? How long the project will last? Okay. So planning of all this. Then you decide, okay, you will invest in the project. Then evaluation of the project by the different techniques that you are having. Payback period, NPV, IRR, so evaluation techniques. After doing the evaluation, selection. Whichever project has got highest NPV or whichever project has got highest IRR. So like that, selection of the projects. After you select the project, implementation of the projects. Actually investing in the project and your business starts, your project starts working. So administration of the project, running of the project, management of the project, controlling of the project, implementation, and finally control of the project. Meaning that you have expected cash flows for all the years. Whether you are receiving all those expected cash flows as per your estimations or not. If not, then where you are going wrong, rectification. And ensuring that if the project is going off track, to get it back on track so that your final target is met. So control, evaluation, selection, implementation, control. Budgeting process, capital budgeting process. Okay. The evaluation techniques we have studied, payback period, when the annual cash flows are uniform for all the years. Formula, I told you, initial investment upon average annual cash flows. When the cash flows are different for each year, then we don't use the formula. We make use of cumulative cash flows. Instead, we calculate cumulative cash flows, determine the year in which the cumulative cash flow is greater than initial investment, and then calculate the payback period as payback period is equal to completed years plus fraction of the subsequent year. Acceptance route for payback period, accept that project which has got a lower payback period compared to discounted payback period, where we are making use of the discount rates. So all the cash flows will be discounted, and we calculate cumulative cash flows, which are cumulative discounted cash flows. Then again accept that project which has a lower discounted payback period. Average rate of return, ARR method. Formula is, please write down the formulas in the exam, because I told you for ARR there are more than 100 formulas. More than 100 formulas. I think I'm joking. I'm not joking. There is a book called, if you get your hands on, a book called Financial Management by Prasanna Chandra. There are more than 100 formulas over here. Okay. So why I'm insisting? Because examiner should know, because there are options, there are alternatives for this formula. So you will clearly write down the formula: average net profit after tax upon average capital employed. Okay, multiplied by 100. Average capital employed, I've told you. CA Institute has given you formula for that. Please follow the formula. Salvage value plus half into cost minus salvage value plus additional working capital is there. After calculating that, your principle for acceptance is select that project which has got the highest ARR. Then we have net present value. The net present value formula is present value of cash inflows minus present value of cash outflows. Here we divide the cash flows into three parts. Initial cash flows, which will have only capital cash flows, capital income, capital expenditure, capital profit, capital loss. Purchase of new asset, sale of new asset, installation charges, which are incurred, carriage inwards, transportation charges of the new asset that will be taken into consideration. Okay. Annual or subsequent cash flows will normally have annual recurring and revenue items. Items which are going to come on an annual basis, items which are recurring in nature, and expenses or incomes which are revenue in nature. Last, you have terminal cash flows, which are going to have only maximum two types of items. Income from salvage value of the assets of the project sold, and working capital if invested at the beginning will be released at the end of the project. Okay, so that is your terminal cash flow. Acceptance rule. In case of individual projects, accept if NPV is positive. In case of mutually exclusive projects, accept that project which has got a highest NPV. Now, this part is most important for you. In case two projects with a different lifespan, decision should be based on equivalent annualized cost and not on the basis of NPV. So the two projects, one project has got 8 years, other project has got 10 years. Then you cannot compare the NPV. They say evaluate the project, but they will not tell you evaluate by your ESC. They will just say evaluate the two projects. So you can't calculate NPV and compare. You have to calculate the ESC. Okay. Profitability index method. Formula: present value of cash inflow divided by present value of cash outflow. Acceptance rule. Accept if the profitability index is greater than 1 and reject if the profitability index is less than 1. Internal rate of return method. Accept if IRR is greater than cost of capital and reject if IRR is less than cost of capital. Okay. Modified internal rate of return. This was just done yesterday. MIRR, where the formula is cash outflow into 1 plus R is to N should be equal to total terminal value for cash flows. At the examination level, you normally have comprehensive problems. Comprehensive problems meaning those questions where you have more than one method of solving. So you don't have only NPV method or only IRR method. Normally they give you a combination of methods. Okay. So now you can see a typical examination problem will look like this. Management of P Limited is considering selecting a machine out of 2 mutually exclusive machines. The company's cost of capital is 12% and the corporate rate of tax is given to you as 30%. Details of the machine are as follows. Cost of the machine is given 10 lakhs and 15 lakhs. Expected life is 5 years and 6 years. So NPV, when you're calculating, in case you are comparing the NPV, you can go to know this 5 years and 6 years. Annual income before tax and depreciation is given to 3,45,000 and 4,50,000. Depreciation to be charged on straight line basis. Calculate. Discounted payback period, NPV and IRR for each machine. Advise the management of P Limited as to which machine we should take. So they are having more than one method as in the problem. We are having the NPV method, the IRR method, as well as the payback period. Okay. So let us see. All the rates of discount and the present values are given. So normally you don't have to calculate the present values. They will give you the present values. Normally, if they are giving, they will give you either 3 decimals or 2 decimals. If they are given, take the values that they are given. Sometimes what happens? The values that they are given are sometimes incorrect. Sir, when I calculated, I got this figure, but they are showing some different figure. Never matter. Whenever they have given the figures, if they have given the wrong figures, they are responsible. We are not responsible. So take the figures as given by them. Even if it is wrong, you will get marks, you will get full marks. But if you put in your figures, you will get 0. That is a tragedy of this. You go to rectify their problem and say that their figure given is different, is wrong, and you put in the correct figure and so on, you will not get it. So, whenever they have given the figure, even if it is wrong, you continue with the figures that they have given, you can be sure that they will give you full marks if you have calculated the answer with their figures. Computation of annual cash flow system. Normally, we start with EBDT. So EBDT, that is annual income before tax and depreciation, is given to you. It's 3 lakh 45 and 4 lakh. Okay. So we start with EBDT, less depreciation. Straight line method. Cost of the machine is 10 lakhs in the first case, divided by 5 years to 2 lakhs. 15 lakhs divided by 6 years. So that will come to 2 lakh 50,000. Salvage value they have not given for either of the two machines. So net profit before tax, less the tax at 30%. You get net profit after tax, add back the depreciation, you get the annual cash flows. Since you are doing comprehensive profit, and the 3 methods that you are having are the discounted payback period, that means you require the annual cash flows and the cumulative annual cash flows, and you have the NPV and the IRR. So we'll prepare a comprehensive statement like this for machine 1 and machine 2. Year column, present value factor column, which will be common for both the machines. Cash flows, present value of cash flows, and cumulative present value of cash flows. So all the figures of cash flow for machine 1, it is going to be the same for all the years, 3,01,500. Multiply by the discounting factor, you get the respective present value of cash flows. So 3,01,500 into 0.893, you will get this 2,69,240. 3,01,500 into 0.797, you get this. Like that, all the present value of cash flows you will get. Then you take the cumulative present value. So 269 plus 240 is 5,09,000. 5,09,000 plus 214, 7,24. Plus 191, 9,15. Plus 170, 10 lakh, like this. Same way you do for machine 2 also. Cash flow is going to be 3,93,500. So multiply that to the discounting factor. So discounting factor is common for both. So multiply, you'll get the present values of all the factors. Take the cumulative present values. Cost of the first project machine is 10 lakhs. Yes, it is 10 lakhs. Second machine, it is 15 lakhs. So if I go to find out the discounted payback, 10 lakhs, it is between the 4th year and 5th year. So 4 years plus fraction of 5th year. What is the fraction? Out of 10 lakhs, I have already recovered 9,15,958 here. So the balance I will recover out of the next year's cash flow, 1,70,000. So I get that as 4 years plus 0.49 to 4.49 years, or 4 years and 179 days. If you want to get the number of days, you have to multiply by 365. The decimal you have to multiply by 365. For machine 2, the amount is 15 lakhs. So 15 lakhs is somewhere here. So between the 5th and 6th year, the 5 completed years plus fraction of 6th year. Out of 15 lakhs, 14 lakh 18,000 we have already covered here. So the balance will be covered out of next year's cash flow of 1,99,000. So 5 years and fraction. That fraction comes to 0.41. So 5.41 years or 5 years and 140 days. So as per this, whichever is less you will do. So you will go for machine. Okay. So that is as per discounted payback. Now, NPV is present value of cash inflow minus present value of cash outflow. Now, present value of cash inflow will be this total 10,86,900 and 14 lakh, sorry, 16 lakh 18,070. So 10,86,909 minus 10 lakhs, that gives you the MPV of 86,909. 16 lakh 18,074 minus 15 lakhs gives you the LPV of second machine. Whichever is higher, so I will be selecting machine 2. So in the first case, I will be selecting machine 1. Okay, machine 1. In the second case, I will be selecting machine 2 because that machine 2 has got higher LPV. Internal rate of return 10 lakhs divided by initial investment divided by ASCF, that is 3.3167. So I will look at 3.3167. I will have to look at the annuity value tables. Is good. Now, what you have to do is in the examination, you will have to take the total of all these figures. Okay, total of all these figures over here. So what you will be doing is you will be having one more column. Then you take the total of all the 12% figures, 13% figures, 14% figures, like that. And whatever figures you get there, you will compare that with the figures that you are getting here, 3.3167. So you will come to know that this is lying between 15 and 16%. So calculate present value at 15%, present value at 16%. Do the interpolation. Okay, interpolation same way that we do. 15% figure here, 16% figure here. Required figure is the same. Okay, so 15% figure is 10 lakh 10,900. 16% figure is 9 lakh 87,000. Required value is 10 lakhs. Cost of goods. So difference between first and second, difference between first and third. Same thing I've done here. But I have not shown you the diagram. So that diagram you can do and then put the values here. You get the value of IRR is 15.46. Same thing you do for machine 2 also. You get the IRR of this as 14.7. So in IRR, whichever is higher, that we select. So 14.74 and 15.46. That means I am going to select machine 1 again for selection. So discounted payback period, I will select machine 1. NPV, I will select machine 2. And internal rate of return, I will select machine 2. So machine 1 has a lower payback period and a higher IRR. Therefore, machine 1 should be selected. Machine 2 has got only one benefit. Machine 1 has got two benefits. That is, two methods are giving thumbs up to machine 1. Okay. So machine 1 has a lower payback period also, and it has got a higher IRR also. Therefore, I will be selecting machine 1. So, typical examination question. See that you are able to solve this question within 20 minutes. I told you yesterday, 15 to 20 minutes max you can take for solving your problem, any problem. Because you don't have time in the examination, you have to write your economics paper after your FM paper. FM paper is not the only paper. Don't be carried away that you are finding that problems are easy and you are taking your own sweet time to write. Then in that case you find that when you complete your FM paper 3 hours ago. Don't do that. You still have your economics paper to be done. So complete your FM paper as soon as possible. So that is what I'm saying. 15 to 20 minutes per question. Should not be more than that. Okay. We'll take a small break over here. 10 minutes break. It is 7:55. I will come back at 8:05. Sharp. Shall we start?
Yes, sir.
Yes, sir.
Risk analysis in capital budgeting. Very simple topic. Normally, they will ask you questions based on certainty equivalent cash flows, C values. Let us go through this question. Gaurav Limited uses certainty equivalent approach in the evaluation of risky proposals. The following information regarding new project is as follows. For year 0, they have given -4 lakh that is your investment in the project. Certainty equivalent portion for year 0 will always be 1. Then they have given for the 5 years cash inflows with the respective certainty equivalents. Riskless rate of interest, that is risk-free rate of interest on the government securities is 6%. Determine whether the project should be cancelled. Now, here one word of caution. I may give you in the question, okay, cost of capital 10%. Never take the cost of capital. Always you have to take the risk-free rate of investment. So riskless rate of interest is risk-free rate of interest. Okay. So always take into consideration the risk-free rate of interest. Ignore the cost of capital if given also. I told you the reason for this. Because when you multiply by the certainty equivalent quotient, you are removing the uncertainty in that. You are removing the risk factor in that. So whatever cash flows remain are the risk-free cash flows. So certainty equivalent cash flows are actually risk-free cash flows. Right? So you have to discount not by the cost of capital, but you have to discount by the risk-free rate of return. Okay. So expected cash flows given, you multiply by the certainty equivalent cash flows, certainty equivalent quotients, you get the certainty equivalent cash flows. Discount them at the cost of at the risk-free rate of interest, sorry, that is 6%, and you will get the total present values. Once you get the total of present values of all the cash inflows, minus it from 4 lakhs. Okay, so you will get your NPV as 2,58,776. As NPV is positive, project should be accepted. So, and this topic of risk analysis should not be that much considering you are bothering with. So normally, it should be very simple questions. They will ask you more questions on capital budgeting and concentrate less on risk analysis. Dividend policy, a very important topic. Dividend policy, factors affecting dividend policy. Again, they will ask you a theory question on this. The shareholders' expectation, how much dividend you are going to pay, what is the dividend policy that you are going to have, depends upon shareholders' expectation, how much is the shareholder expecting in the current year. Financial needs of the company. That if you are having requirement of finance for expansion of business or purchasing some new assets in the near future, then you would not like to distribute the entire profits. You would like to retain a part of the profits. So dividend payout ratio may not be 100%, it will be less than 100%. Legal restrictions. Sometimes there are covenants in the loans, loan agreements. Uh, in the sense that if you are taking a loan, the bank may restrict you from paying dividend of more than 10% or something like that. So restrictions which are arising out of legal compulsions. Liquidity, how much of cash you are having. Profits are not the sole criteria because profits may not be reflected in cash. Profits may be reinvested in the business. So how much of liquid cash you are having in the balance sheet, which you can afford to spend by way of dividend payment. So liquidity is one factor. Access to capital markets. Today, if I distribute the profits, tomorrow, if I require capital, will I be able to raise capital in the financial markets easily? That is one of the factors. That inflation, again, cost of capital increasing, the cost of your borrowings increasing, will not be able to get easy loans. Taxation, benefit of taxation. If I go for debt capital, if I go for loans, then what will happen? If the tax benefits are same way when I'm paying the dividends, will I get some tax benefits? Answer is no. So by payment of dividend, if I have to pay additional tax, that is corporate dividend tax or dividend distribution tax, then it is not advisable to go for equity capital or preference capital. It is better to go for your debt capital. So dividend policy, how it is going to affect my your taxation. So preference dividend, I have to pay dividend distribution tax. Equity dividend, I have to pay dividend distribution tax. So I will pay less dividend. So my outflows of cash are less. Control and the nature of money. These are the factors affecting the dividend policy. Types of dividend policies, you can refer to your caps material. Constant payout ratio dividend policy. That is constant DPR. Constant payout ratio means constant DPR. Constant rate of dividend, 10% on the face value or 15% on the face value. Small constant dividend per share plus extra dividend. Minimum amount is guaranteed. Over and above that, if the profits are there, then we'll pay extra dividend. Uniform cash dividend plus bonus share policy or residual policy. Residual policy sometimes have been asked in the examination. So residual policy will be important for you. What is the residual policy of payment of dividend? Whatever are the profits available with you at the end of the year. If you feel that you are requiring the profits for further expansion, as I told you, further requirements are there, further expansion of business or investment, additional investment is required in some project. And along with the investment in project, we require some additional working capital also. So after keeping aside all those requirements for capital purpose, whatever is the balance, whatever is the residue, that will be distributed as dividends. So first I will find out how much I require for my business in the future. After that, I will find out what is the balance after payment of all these things. So residual value will be declared as dividend. So residual policy important. Then traditional position, which is given by Graham and Dodd. The formula, all the formulas you have to refer. So P is equal to M into multiplier into D plus E by 3. All the figures will be given, you just have to substitute. Walter's model. Over here we can, as I told you, D plus B is your dividend per share. R is your internal rate of return. E is your earnings per share. So R into E minus B divided by K, the whole thing divided by K. So I can further simplify this or write this in a better form. I can write D plus R by K into E minus B upon K. Okay. In Walter's model, you have to remember these 3 points. So conclusion or summary of Walter's model. If your rate of return is greater than the cost of capital, that means you can give the shareholders. See, what is basically Walter's model? Walter's model says that if the shareholder can get better returns, then the company is better to declare the entire profit. But if the company can give the shareholder a better return than what he is expecting, then it is better to retain the profits. Okay. So let us say, for an example, in an annual general meeting, the directors of the company say that we don't want to declare the profits as dividends. Shareholders say, no, you have to declare dividend because we want the profits. You ask the shareholders, how much returns are you expecting? Suppose I give you the deal and you invested something. What are you expecting in return? The shareholder will tell you, we'll invest and get 12%, 9%, 10%. Now, suppose you can give them more than 12% returns. You can give them 15% dividend next year. That means your rate of return is greater than the cost of capital. Then retain the entire profits. Tell them, I can give you 15, you are requiring 12%, I'll give you 15%. Let the profit be you. Right? So you can have 100% retention. R is greater than K, 100% retention. EPR is 0. Dividend payout ratio, nothing is actually paid by the company. Everything is paid. R is less than K. I tell you that, okay, you can get 12%, I can't give you 12%, I can give you maximum 8%. So better that profits are there with you. So then pay out the entire profits. Dividend payout ratio 100%, 0 retention, nothing is given. R is equal to K. If I give you the money, you will get 12% returns. If you keep the money with me, I will also give you 12% returns. It doesn't make a difference whether money is with you or money is with me. So no effect on the dividend policy. DPR is 0 to 100%. Dividend will not be. That is when R is equal. Then Gordon's dividend equalization model. Let's study this one. Dividend irrelevance theory. This formula is this one, which normally we sometimes also write as 1 upon K, 1 upon 1 plus K. We separate it into E1 plus P. So price of a share calculation, value of a firm. These two formulas are important. John Brinker's formula, again, formula is important. Study the formula. All the figures will be given, you just have to substitute the values. Let's go through these questions which are given here. Let's solve examples. Coming to cash management. I want to explain to you, solve with you right now. The example one of cash management. Normally, cash management very rarely asked in the examination of FM. It is more asked in the costing exam because it's nothing but a cash budget. But in case it comes, you should know how to solve it. I've taken a very comprehensive. I've taken a problem with lots of adjustments and lots of new information. So I want to explain to you the solution and how to arrive at the solution. Because if it comes as a 10 marks question, you can be sure that you will have a tough time. So let us go through this example one. You are given a cash budget from Jan to June 2020. But details are given from November to June. You are supposed to prepare a cash budget from Jan to June. The first thing that you have to keep in mind is understand the period for which the budget is to be prepared. It is to be prepared for 6 months, starting from Jan up to June. So why they have given November and December figures? Because sometimes that is going to affect my Jan figures. Okay, so if the sales are taking place where the credit period is 3 months, so November sales I will get the amount in Jan. Okay, so that is going to affect my calculations. 20% of the what are data are going to sales, material purchase, wages, and office expenses. 20% of the sales are for cash. Okay, so whenever you are solving collection from debtors or amount receivable from debtors, remember that 20% of the sales are for cash. So your credit sales are 80% of the sales. 50% of the credit sales are collected after 1 month. 30% in the second month. and a balance in the third one. The balance in the third one, 50 and 30, 80. Okay, so 20% is collected in the third one. Firm has a gross profit of 25% on sales. That means cost of goods sold is 75% of sales. Materials are purchased on a credit period of 2 months. Advance tax is to be paid. Advance tax is to be paid in March and May. 70,000 each. Okay. Debentures worth 60,000 will be sold in Jan. 60,000 sale in Jan. Cash receipts. Cash balance starts on 31st December. Now this, why I'm doing this problem with you, especially for these two adjustments. Okay. So cash balance as on 31st December is 40,000. The firm maintains a minimum cash balance of 40,000. So this part is important for you. Firm maintains a minimum cash balance of 40,000. Funds can be borrowed in multiples of thousands. Borrowings in multiples of thousands at 12% per annum interest payable on monthly basis. Maximum cash balance of the firm can keep is 50,000. Maximum cash balance is 50,000. Any surplus amount can be invested in multiples of thousands. Investment, if you are doing in multiples of thousands. And what is the interest that you are going to get? Interest is 10%, which is again receivable on monthly basis. I don't think we have done such a question in the class, right? Because not absolutely, I don't see this particular type of question. So that is why I've taken this, because the 7th and 8th adjustments are very good. How to adjust that cash balance? Because we are given minimum cash balance to be maintained and maximum cash balance to be maintained. It should not be allowed to go below 40,000. That means minimum 40,000. If I don't have 40,000, I will borrow. If I don't have 40,000, I will borrow. And borrowing has to be done always in multiples of thousands. So I can't borrow 1,500. I will either borrow 1,000 or 2,000. I can't borrow 5,700. I will borrow either 5,000 or 6,000. So this is going to create problems when we are going to solve it. So we have to be very careful. Same way when I'm having surplus cash, more than 50,000 cash, I'm not allowed to keep more than 50,000 cash. If I have 80,000 cash, I will keep 50,000, 30,000 I will invest. And whatever I invest, I will have to get the returns on that at the rate of 10% per annum on a monthly basis, and that will be shown along with my receipts. Payment of interest on loans should be shown along with my payments. So that is also there. So we have to adjust all these things in our cash flow. That is why I want to do this with you. Okay. So now we start with the receipt part. But before I start with the receipts, I will prepare a small working note to calculate what is the amount of collection from debtors. Okay. So collection from debtors. This is a very important calculation. What do? I go to the sales given to me. Okay. Sales are given to me in the problem. 2 lakhs, 2 lakh 22, 1 lakh 20, and so on. And at the same time, I'm also given that 20% of the sales are for cash. So the first job that I'm having on is I will calculate all the sales 80%. So 80% of 2 lakhs, 80% of 2 lakh 22, right from November I will calculate. Okay. So 80% of 2 lakhs, 80% of 2 lakh 22, like that I calculate 80% figure for all the months. Okay. So I'll write over here 80% of total sales. Okay. So once I calculate all the 80% of the sales, now how I'm going to work out? They have said 50% of the amount. 50% of the amount. Let's come to that. 50% of the credit sales are collected after 1 month. So November sales, 50% will be collected in December. 30% will be collected in second month. 30% of November sales will be collected in Jan. And 20% of the November sales will be collected in Feb. So December, Jan, and Feb. 50, 30, and 20. Okay, remember 50, 30, and 20. November sales, look at this figure, 1,60,000. 50% of that is in December, 80,000. 30% of that is in Jan, 48,000. It comes diagonally. And 20% of 1,60,000, it comes in Feb. So I have written here 50%, 30%, and 20%. So you will find that all the figures will come diagonally like this. Okay. Then second figure is 1,77,600. Okay. 1,77,600. Out of this 1,77,600, 50% comes in Jan. 30% comes in Feb. 20% comes in March. Like that, I will be having Jan 96,000. 50% comes in Feb. 96, 50% is 48. 30% comes in March. 20% comes in April. Okay. Again, I go back to Feb. Feb is 88,000. 50% of 88,000 is 44,000. 30% is 26,400. 20% is 17,600. March. Again, for March, I will take 50% of March sales. 96, half is 48. 30% is 28,800. 20% is 19,800. Okay. Next one is April. April is 1,92,000. Half of that 96 here, 57,600. Okay. May again, I will be having 1,60,000. Half of that in 80. Nothing here below. After beyond June, I will have anything. Okay. 1,60,000 here. Okay. Now, all the figures you can see, all the figures are ticked off, excepting for this figure. From where this figure I have taken, I have written over. It is assumed that, see, for this figure to come, I should have some sales in October. So if I have some sales in October, then I can say 50% in November, 30% in December, and 20% in January. But I have not given the sales of October. So I have assumed, what I have assumed, October sales are the same as November sales. Which means that October also I am having 1,60,000. So 50% of 1,60,000 is 80,000, then 48,000, then 32,000. Okay, so that is the most important thing that I've got to explain. Then we start taking the sales because we are preparing from Jan to June. So I want only this period. Okay, I'm not calculating for numbers, so only this period. So I get 168,800 for Jan, 133,280 for February. Right? Now, calculation of collection from debtors is over. That is a big calculation that I wanted to show, especially the figure of this 32,000. From where I got this 32,000. Now you have understood the figure. Let us come back to the statement. Cash receipts, opening balance I start with first. There's a minimum 40,000. So cash balance was on 31st December. They have given to me over here as 40,000. So opening balance of Jan is 40,000. Cash sales, 20%. Cash sales is 20% of total sales. Okay, 20% of 2 lakhs. Sorry, 20% of Jan. 20% of Jan sales, 1,20,000. So that is 24,000. So in the same month I will get that 24,000. Like that, 20% of Feb sales, 20% of March sales, 20% of April sales, 20% of May, 20% of June. Right? This is from debtors from the working note that I wrote. All the figures will be taken from 168,800, 133,280, all those figures from there. Okay. Sale of debentures 60,000. Debentures are sold in January. So in the month of January, I will be receiving cash receipts 60,000. All these figures are there. Then interest received on investment, I will come back to that later on. Paid to creditors 136.5. Now payment to creditors, what they have said. Materials are purchased on a credit of 2 months. So that means November purchases I will pay in January. December purchases I will pay in the month of February. Jan purchases I will pay in the month of March. So 136,500 in Jan. 136,500 in Jan. 66,000 in Feb. This is the December. And then this is all your 2 months sales, 2 months purchases, 2 months bill. Okay. So whatever was your purchase in November, that has been shown in Jan. Payment is made in Jan. So 1,36,500 is your November purchase, then December purchase, then Jan purchase, then Feb purchase, then March purchase, and May purchase, April purchase. Then wages paid. You have got the wages paid. Now, what they have said about wages paid, have they said anything? No. Nothing is said. So we'll assume that the wages are paid in the same month. So Jan 24,000, Feb 24,000, March 24,000, then 30, 27, and 27. 24,000 Jan, Feb, and March, April, May, and June in the same month. We just paid in the same month. Office expenses, have they mentioned anything? Nothing is mentioned. So office expenses also in the same month I will show. 21, 30, 24, 27, and so on. So in the same month, 21, 30, 24, 27, 26, 27. Then they have given advance tax paid in the month of March and May, 70,000 each year. Okay, 70,000 each. So advance tax payment 70,000 in March. Okay, up till here it is clear. Now what we do is, you can see that all the receipts have been taken care of, except that interest received on investment. All the payments are taken care of, except that investment borrowings. So I will leave a line for the receipt because that interest may come. I will leave a line for payments also because interest on borrowings will come. May come. I don't know. Now I go vertical. Okay, vertical. Now this February opening balance, March opening balance, I have not got. I have to still get. Because those opening balances will be the closing balance of the previous year. So now I take vertical. Vertically, Jan total comes to 2,92,800 total receipts. Payments comes to 1,81,000. So on the cancel, if you take 2,92,800, okay, minus 181,500, you will get 1,11,300. Surplus or deficit. A minus B, 1,11,300. Okay, now, what we have to understand is that we cannot keep a balance below 40,000 minimum cash balance. Minimum cash balance is 40,000. Maximum cash balance is 50,000. So what does that mean? It means that below 40,000 it should not be. Above 50,000 it should not. Now this is the trick that you have got this. What is the surplus that I am having? 1,11,300. 1,11,300. Paid and should. Maximum I can keep with me 50,000. If I keep 50,000 aside. How much is surplus? 61,300 is surplus. Okay, 61,300 is surplus. What should I do with the surplus? I should invest. But can I invest 61,300? I can invest only in multiples of 1,000. So either I invest 61,000 or I invest 62,000. So suppose I invest 61,000, what will happen? This balance will become 50,300. Or if I invest 61,000, I will have balance of 50,300, which I can't have. I can't have more than 50,000. I should have less than 50,000. So I will invest 62,000 here. What will come here? 49,000. Can I have 49,300? Yes. Maximum is 50,000. I can have less than 50,000. Right? So investment will be of 62,000. Investment will be of 62,000. So every time I have to do this. Every time I have to do this. I should ensure that it does not cross 50. I should also ensure that investment or borrowings are made in multiples of 1,000. So both the things I have to check. Okay. So 62,000 is my investment. So if I invest 62,000 from 1,11,300 minus 62,000, I will get 49,300. This 49,300 is my closing balance of Jan, which becomes my opening balance of Feb. Okay. Now, 49,300, if it is my opening balance, and 62,000 I have invested. 62,000 I have invested. What is my returns on investment? 10%. 10% per annum. So 62,000 into 10% for 1 month. For 1 month. What is my interest? 516.67. So I take it as 570. Calculate it. 62,000 into 10% for 1 month. So 6,200 divided by 12. It comes to 516.67. So that is 570. So I will be writing interest on investment. Okay. So how did I get this 517? It is 62,000 into 10% divided by 12. Okay. After that, I will take the total. The total comes to 2,05,097. Minus of that 1,20,000. I get a balance of 85,097. Again, same problem. 85,000 is more than 50,000. Okay. So what I do? 85,097. I require to maintain a minimum balance of 50. So surplus I got 35,097. But I can't invest 35,097. What I will do? Invest 35,000? No. I will invest 36,000. Okay. So here I will invest 36,000. Always I will invest on the higher side. 36,000. So what will this amount be then? What will be this amount? 49,097. Okay. So 36,000 gets invested. And I have 49,000 closing balance. This 49,000 closing balance becomes opening balance. Now, understand problem. Pay attention. How much investments I have? I have 62,000 plus 36,000. Common mistake made by students. They calculate on 36,000. What about the old investment? So 36,000 plus 62,000. 62 plus 36 will give me 98,000. Into 10%. 9,800 divided by 12. 816.67. So that comes to 807. So this is 98,000 into 10% divided by 12. 807. Okay. After I do that, I'll calculate the total of all the receipts. 182,234 minus from that 176,500. I'll get a balance of 5,734. I'll get a balance of 5,734. Now what do I find? And it is gone below 40,000. So I have to maintain it at 40,000. Okay. So I have to borrow. But I will not borrow. Why? Because I've got investment of 98,000. I will sell the investment. How much investment I will sell? Now for 40,000, what is the deficit? 5734. The deficit is 34,266. See, I require a balance of 50,000. Okay. Sorry, 40,000. Minimum I require 40,000. How much I'm running short by? So 40,000 I minus 5734. I'm running short by 34,266. It's my shortage, 34,266. But can I sell investment of 34,266? Selling also I have to do in multiples of 1,000. So either I can sell 34,000 or I can sell 35,000. If I sell 34,000 of investments, 34 plus 5, 39,000. It does not count because I require a minimum of 40,000. So I will sell investments also on the higher side, 35,000. So investments sold, cash coming in 35,000. Okay, 35,000. So now my total balance will be 40,730. Minimum is 40. I can have more than 40. So 40,734. This comes as opening balance. Now how much investment I'm having? 98,000 minus 35. 98,000 minus 35,000 is 63,000. 63,000. On that I will calculate 10% for 1 month. So divided by into 10% divided by 12. So that comes to 525. Exact 525. Okay. Again I take the total. Minus 1,80,23. Again I get 59,859. Again it goes more than 50,000. So I'll calculate again. 59,859. 59,859. So if I keep aside 50,000, I will have 985. But I can't invest in 985, so I will invest 10,000. Okay, and this will reduce. 59 minus 10 is 49,850. So investment purchase, cash outflow minus 10. Balance will come down to 49,850. Right? Again, this balance goes up here. 49,850. Now, recalculate the investment. 62 plus 36 was 98. 98,000 minus I sold 35,000. Now again I purchased 10,000. So now I'm having 73,000. 73,000. 10% is 7,300. Divided by 12, it comes to 680. Correct? Take the total of all the receipts in it. You get this minus 274. Now I get minus 41,150. Minus 41,000. So that means I have to bring in cash. Either I have to take a loan or I have to sell my investments. Now, how much investments I'm having? 98 minus 35. Okay. Plus 10. I'm having 73,000 maximum. But what is my deficit here? My deficit is 41,133 plus 40. I have to maintain plus 40. So 81,133 I should have. At least 81,000 change. Okay. Now, first what I will do, sell off my investment. How much investments are there? 73,000. Sell off the entire investment. Still I'm falling short because 73,000 if I have, minus from that 41,133. I still have a shortage of 31,867. Sorry.
9,000. 81,000 minus 70.
81,000, 8133 deficit. Okay, so 8133. I cannot take a loan of 813. So what I will do? I take a loan of 9,000. So 9,000 loan is taken. Again on the higher side. And I will bring it to 40,000. Okay, so 40,867 comes here. Now I don't have any of my investments. All my investments are gone. So this 62,000 plus 36 minus 35 plus 35 minus 10 and this 73, they all wipe out each other. So now no investments are there, but loan is there. What is the interest on loan? 12% per annum, so 1% per month. 1% of 9,000 is 90 days. Interest paid on loans, 90 days. So I take the total of all the leases, including that 90 days, 1,77,000. I get a balance of 60,577. 60,577. Again, I do the same calculation. I have to maintain a minimum balance of 50,000. Okay, so 60,577. Minimum balance, maximum balance of 50,000. So I have 10,577. So I will invest 11,000. No, I could have invested 11,000, but what I will do? 11,000 I have to take it. 11,000 I will utilize first to repay my loan. Okay, first I will repay this loan. So out of 11,000, 9,000 has gone for loan repayment. 2,000 I will invest in the outside securities. Okay, so 60,577. Out of that, first loan repayment of 9,000 and balance 2,000 I will invest in the outside securities. Total balance 49,000. This is the calculation. Okay, so you must not imagine that we can have a cash budgeting problem so tough, but it is possible. Where I give you the loan restrictions, I give you the investment restrictions, I give you the restrictions of the balance. Then in that case, you have to do all this trouble of calculating the interest on investment, calculating the interest on loan. Whenever cash is required, sell off the investment first. If you are falling short, then go for it. Suppose the investments were not there at the beginning and the loan was there, then I will start with the loan. And if I have surplus balance afterwards, first I will repay the loan. Then the amount balance will be invested also. Okay, so this is a comprehensive problem, cash management, preparing a cash budget, which you have not done before. I would suggest once a day before going for exam, solve this entire question so that you get the confidence that you can do it. Now I have done it. You have just observed. So practice this question at home without looking at the solution and see if you get the confidence of solving. Any difficulty? Any calculation that you have not understood? Then all calculations you have understood. Annual cash requirement of Agratar Limited is complex. Company has marketable securities. This is your commerce. Company has marketable securities in lot sizes of 50,000, 1 lakh, 2 lakhs, 2 lakh, 15 lakhs. Cost of conversion of marketable securities per lot is 1,000 rupees. The company can earn 5% annual yield on securities. You are required to prepare a table indicating which lot size will have to be sold by the company. Show that the economic lot size can also be obtained by the company. So that is what I do is my annual requirement. My annual requirement for the company is 10 lakhs. Okay. Now, if I'm going to have annual requirement of 10 lakhs, I can have them in lots of 50,000 or 1 lakh or 2 lakhs or 2 lakh 50 or 5 lakhs. So lot size is given to you. So first I write the total annual requirement, then I write the lot sizes. Then I divide each annual requirement by the lot size. So 10 lakhs divided by 50,000, I will get 20. 10 lakhs divided by 1 lakh, I get 10. 10 lakhs divided by 2 lakhs, I get 5. 10 lakhs divided by 250, I get 4. 10 lakhs divided by 5, I get 2. So number of lots, 20 lots in the first case, 10 lots in the second case, 5 lots in the third case, 4 lots in the fourth case, and 2 lots in the fifth case. Cost of conversion of each lot is 1,000 rupees. Cost of conversion is 1,000 rupees. So 1,000 into 20 is 20,000. 1,000 into 10 is 10,000. 1,000 into 5 is 5,000. 1,000 into 4 is 4,000. 1,000 into 2 is 2,000. Okay. So let's call this as result number 1. Now average lot size. Average lot size, I divide each lot size by 2. 50,000 by 2 to 25,000. From here, 1 lakh divided by 2, it is 50,000. 2 lakhs divided by 2, it is 1 lakh. 2 lakh 50 divided by 2, it is 1 lakh 20. 5 lakhs divided by 2, it is 2 lakh. Why do I divide this like this? Because opening balance I take as 0. Closing balance is 50,000. So 0 plus 50,000 divided by 2. Opening balance is 0 and I'm having 1 lakh. So 0 plus 1 lakh divided by 2. 50,000. So in other words, it is each figure of lot size divided by 2. I'll get the respective average lot size. Average lot size, I will then multiply by the 5% yield. Okay, 5%. So 5% of 25,000, 1,250. 5% of 50,000 is 2,500. 5% of 1 lakh, 5,000. 5% of 1 lakh, 25, 65. 5% of 2 lakh 50, 12,000. This one call as result number 4. So what is my total cost? The total cost is 1%. 20,000 plus 1,250 is 21,250. 10,000 plus 2,500, 12,500. 5,000 plus 5,000, 10,000. 4,000 plus 6,250, 10,000. 2,000 plus 12,500, 14,500. I have to ensure that the total cost is minimum, which is the minimum figure here. The minimum figure here is your 10,000. Minimum figure is 10,000. So the total cost is minimum for the lot size of 2 lakhs. So what is the economic lot size? It is 2 lakhs. What is the minimum total cost? It is 10,000. Okay. Now they have said show that the economic lot size can also be obtained by Baumol's law. That means if I put all these figures in the formula, I will get the same answer that economic lot size is 2 lakhs. Let us see. 2 into B into D. B is your conversion cost, P is your total annual cash required. So 2 into 1,000 into 10 lakhs divided by rate of interest 5%. So when you take the square root of this, you will get 2 lakhs. Check on the graph. Are you getting 2 lakhs? So 2 into 1,000, 2,000 into 10 lakhs divided by 0.05. Take the square root. When you are silent, I sometimes doubt myself that I feel that my answer is wrong, therefore you are taking right. Are you getting 2 lakhs?
Yes. Yes.
So this is your Baumol's model calculation. This type of problem had been asked in one group. So that is why I redid this problem with you. Table, they ask you to calculate the minimum lot size without using the Baumol's model. And then they tell you, using the Baumol's model, show that answer is going to be the same. Okay. So read the question properly. Now, in most of the answer papers, when this type of question had come, students directly prepared, wrote the formula and calculated. So they had only one part of the problem. They had only this part of the problem. This part was not given at all. So how can we give marks to the students? Because they have not said calculate economic lot size by Baumol's model. Question is not calculate the economic lot size by Bobbles. They are saying you are required to prepare a table indicating which lot size will have to be sold by the company. So this is the first part of the question. This is the first part of the question. And once you get that figure over here as 2 lakhs and 10,000 here, you have to prove that with the help of Bobbles. So read the question properly, because if you don't read the question, you misunderstand the question, your answer will get only half the mark because you have not read the question properly. So very simple problem, but see that you are reading the question properly and then solving it. Right? Any difficulty? Now I just want to come to so any student is having any difficulty in this document that we have got. The question sheet. This is your RTP for May 20. Have you gone through the RTP of May 20? So, Ashwini, have you gone through the RTP of May 2022? Are we?
No, sir.
I was not there. We are very busy people. Let us go through the RTP. Ratio analysis, very simple question. You are given all the ratios, you are supposed to calculate all the items of balance sheet. Cost of capital also is simple. I want to do this capital structure problem. Following data relates to two companies belonging to the same risk class. Particulars are 12% debt, 27 lakhs. Equity capitalization rate for C Limited is given 18%. Expected net operating income is 9 lakhs for both of them. That is expected EBIT is. You are required to determine the total market value, equity capitalization rate, and weighted average cost of capital for each company, assuming no taxes. Assuming no taxes as per approach. And the second one is assuming 40% tax as per MM. Okay. I want you to do it. There will be a problem. Either you can open the May 2021 or 2022 RTP on your mobile, or you can take a pic of this. If you feel that it will take more time, you can just take a pic of this on your mobile. Can you do that? Because I will require to solve this problem on the PPT. Or shall we discuss it directly from the solution? Then what is better? Solving is better, but discussing the solution is better. Yes, Shreya. Solving problem is better or discussing is better?
Anyhow,
Any option is not there. Option A is solving, option B is discussing.
so solving.
So let's take a peek of this, all of it. We'll take this and solve it in a group. Little bit different type of problem, which we are not. So you can see that E Limited is having 27 lakhs as debt, but how much is the equity that they have not given? C Limited is not having debt. So they want us to calculate the equity capitalization rate, the total market value the equity capitalization rate and weighted average cost of capital for each company, assuming no taxes as per MM. Solve it with equity. Yes. No tax and the MM approach. Ready? So if there is no tax, I'll first calculate value of the unlevered firm. Value of unlevered firm. Which is the unlevered firm here? E limited or C limited?
C.
C limited. Okay. E limited has got it. So C limited will be the unlevered. Okay. Value of the unlevered firm is equal to net operating income divided by cost of equity. Or I can take it as net operating income divided by overall cost of capital. Because cost of equity and overall cost of company will be the same for an unlevered firm because there is only one capital, that is equity capital. Okay. What is the net income given to us? Operating income 9 lakhs. Correct. No? And what is the cost of equity? 18%, 0.18. Just give me the figures. To calculate and tell me how much it is going to be. 9 lakhs divided by 0.18.
50 lakhs.
Okay. Value of unlevered firm is 50 lakhs. Value of levered firm, that is B limited, will be value of unlevered firm plus debt into, remember this formula, debt into rate of tax. You're supposed to remember this formula. Value of levered firm is 50 lakhs. Since it's a levered firm, there will be some debt. What is the amount of debt that is given?
27.
27.
27 lakhs. And rate of tax here, they said no tax. So value of the levered firm is also 50 lakhs. Now, if you look at the question they've asked, determine the total market value equity capitalization rate and weighted average cost of capital for each company, assuming no taxes as per MM approach and having 40% taxes as per MM. Now, equity capitalization rate for C Limited will be 18%. Weighted average cost of C Limited will also be 18%. Why? Because there is only one source of finance. Right? For B Limited, you'll have to calculate the weighted average cost of capital because there are two sources of finance, debt and equity. Okay. So now, how to calculate that? That we will have to see. So we will prepare a statement where we will calculate the weighted average cost of capital and the cost of equity as per normal method. Normal method is what? Statement showing cost of equity, KE and KE. Equity capitalization rate and overall cost of capital. EBIT is going to be as 9 lakhs. Minus interest on debt. What is the rate of interest?
12%.
Calculate and tell me how much the interest will come to.
3,23,000.
3,24,000. So net income available for equity shareholders.
I lakh 76,000.
Overall cost of capitalization. Scale. Suppose it is 18%. Total value of the firm. Total value of the firm is equal to EBIT upon KO. What is EBIT? 9 lakhs divided by 80%, 18%. That comes to 50 lakhs. Minus the value of debt. Minus the value of debt. It's 27 lakhs. So value of equity. Value of equity. S is equal to D minus D. 23 lakhs. Equity capitalization rate is equal to net income divided by S, market value of equity. Net income is 5,76 divided by 23 lakhs. Percentage formula. So 576 divided by 20, 25.04%. This is for C limited. Which that is for V limited. Okay. Now, suppose we have to calculate the WACC for B limited. How do we do this? Computation of WACC. How do we do this? We have source, weights, cost, and weighted cost. Source will be debt and equity. Equity is 23 lakhs. Debt is 27 lakhs. Okay. Cost is for equity we have just calculated 25.04%. And for debt it is 12%. Why 12%? Because no tax is there. If tax was there, I would have calculated 12 into 1 minus 2. So if I calculate now, 23 lakhs into 25.04%, it comes to 5,76,000. $27 lakhs, if I calculate 12%, it's come to 3,24,000. It will be 18%. Okay. Now let us do second part of this. Where rate of tax is 40%. So tax is 40% in MM approach. Yes, good. Tax equals to 40% and the MM approach. Value of unlevered form. C is equal to net operating income. Now it will be net of tax divided by A or B. This is 9 lakhs into 1 minus 0.4 divided by 0.1. 9 lakhs into 60%, and 6 of 50 to 5 lakh 40. Divided by 120. 50 lakhs. Value of levered from T limited is equal to value of unlevered from okay, plus debt into rate of tax. So it will be 30 lakhs plus debt is 27 lakhs into 40%. Forty lakh 80. Okay. Now let us come back to the statement. EBIT is 9 lakhs minus interest 3 lakh 24,000. 5 lakh 76,000 is EBT. It is not net income. This EBT 5 lakh 76. Minus 40% tax. This tax is there. So 5 lakh 76 into 40% is 2 lakh 50,400. 2 lakh 45,600. This is the net income available for equity shareholders. Total value of firm, we have calculated that 40 lakh 80,000 minus the value of debt 27 lakhs $13 lakh 80,000 is the value of equity. Equity capitalization rate net income upon market value of equity. Net income for shareholders 345,600 upon 13 lakh 80. $25.04. AO is equal to EBIT upon value of the firm. EBIT is 9 lakhs. Value of the firm is 40 lakh 80. $22.06. Is it right? Check. It's not right. Why? Go back to my theory, no? Which I did with you. Theory with tax. Did I calculate BO in this manner? Did I give you this formula? I did not give you this one. EBIT upon. What is the formula that I do? AD into proportion of debt. Correct. Plus AE into proportion of equity. This one. Remember the formulas that I gave? I gave you two formulas in that. One is for calculation. Value of levered firm is equal to value of one levered firm plus debt into tax. And this was the second formula. This is nothing but the tabular form of your calculation. Okay. Tabular form of calculation means what? Sources, dates, cost, weighted cost. Sources, you have equity and debt. Value of equity, you have just calculated 13 lakh 80. Debt was 27 lakhs. Cost of equity was 25.04%. What is cost of debt? What is cost of debt? What is the figures here? What is the cost of debt?
12% tax net of
Yeah, 12%, but 12% is before tax. What is your actual cost of debt? 12% minus 40%. How much is that? 12 minus 40%.
7.2.
7.2. 7.2%. So 13 lakh 80 into 25.04%. That is 3 lakh 46,000 approximately. The same thing that we have done. 345,600. 345,600. 7.2% of 27 lakhs. It's 1 lakh 24,400. Total is 12 lakh 4. 5 lakh 40 upon 4 lakh 40 lakh. Formulas you have to study. Every formula that we have done in the class is important. 13.24%. Same theory with facts. Okay. So you can see that in the RTPs also, you are having certain questions which you have, the formulas are which you have already done, but a little bit of application is required of the formulas now to understand how to solve the problem in such a situation. So always go through all the questions that I've done in the class. Never miss out a single one. Even if I've given a small example, go through that example because the application of that will be there in your examination. Solve this entire RTP May 2022 RTP before you go for exam. Okay, compulsorily solve the May 2022 RTP. So we have got questions like this. Other questions are simple. I have not taken that because they are simple and those type of questions we have done in the class before. But still, keep your RTP, solve the questions and check the answers, whether you are able to get it or not. And if you are making a mistake, where actually you are making a mistake, whether it is a conceptual mistake or whether it is the formula you have put it wrong. So analyze that before going for the exam, do the RTP. That is very important. Okay. If possible, if time is there, you can solve an MTP also. Mock test paper is given to you online, so you can download that and solve the MTP also. Okay. So I'll stop here for today and wishing you all the best for your exams. You can do it. You have done all the way. You have gone a long way, and you have really struggled for it and studied for it. So I don't think there is any way that you can lose out. So don't lose confidence now at this particular stage. Whatever may happen to any of your papers, don't relate one paper to another paper. You never know. Because the tension of one paper should not be carried forward to the second paper. Whether it is easy, difficult, leave the paper on the day and start preparing for the next week. Don't discuss the paper with anybody. Don't come and analyze yourself also with the paper. Once the paper is written, forget it. Wait for the results. Okay? So don't let any of the papers affect any other papers of yours. Don't listen to any rumors. Close yourself, close your eyes and ears for all these rumors. You just concentrate on your studies. Practice, practice, practice till the date of examination. Practice as much as possible. Write and practice. Okay? Write and practice. Any difficulty in concepts, redo the concepts, rework out the problems. Solve the entire RTP of May 2022 as well as MT mock test papers. Okay. So with that, wishing you all the best for the exam and see you on the other side for CA. Have a nice day.
Thank you. Thank you, sir.
Thank you.
Thank you, sir.
Thank you.